Hi, in this video we will see the journal entry that has to be passed while treating goodwill on change in profit sharing ratio among the existing partners. There are two methods which are given, a method 1 and a method 2. The net effect of both methods is the same. Whether you pass the journal entries through method 1 or pass the journal entries through method 2, the net effect of both methods will be the same. However, if nothing is mentioned in the question, always use method 1. I repeat, if nothing is mentioned in the question, use method 1. So we'll go into each of these methods. First we'll see when to use these methods, each of them, and next we'll see the journal entry which has to be followed, and we'll specify whether it's fluctuating capital method, then the journal entry what needs to be passed, and in case the fixed capital method is being followed, what is the journal entry that needs to be passed. So let's begin with method 1. Now, method 1 needs to be used when we need to adjust goodwill through the partner's capital or current accounts. I repeat, method 1 is to be used when goodwill needs to be adjusted through partner's capital or current accounts. Now the journal entry will depend on whether the fluctuating capital method is being used or the fixed capital method is being followed. Let's deal with the fluctuating capital method first. The journal entry for treatment of goodwill in fluctuating capital method. In the absence of information, fluctuating capital method is to be assumed. So where the question does not state specifically whether fluctuating capital method is being followed or fixed capital method is being followed, we need to assume that the fluctuating capital method is being followed and pass the following journal entry. The gaining partner's capital account has to be debited and the sacrificing partner's capital account has to be credited. How much amount should we write against the gaining partner and the sacrificing partner? For the gaining partner, we need to debit his capital account with the amount of compensation payable, and for the sacrificing partner's capital account, we need to credit the sacrificing partner's capital account with the amount of compensation receivable. And we've already seen earlier how to calculate the compensation payable by the gaining partner and the compensation receivable by the sacrificing partner. We need to take the value of the goodwill of the firm into the share gained or the share sacrificed to get the amount. The narration is being goodwill adjusted on change in profit sharing ratio. What if the fixed capital method is being followed? The same journal entry needs to be passed, but not through the partner's capital account but through the partner's current account. So we will debit the gaining partner's current account with the amount of compensation which is payable by him, which is the value of goodwill of the firm into the share gained by the gaining partner. And we need to credit the sacrificing partner's current account with the amount of compensation receivable, which is value of goodwill of the firm into the sacrifice of the sacrificing partner. And narration being goodwill adjusted on change in profit sharing ratio. So the first method we need to follow if goodwill is to be adjusted through partners' capital or current accounts. The second method, let's go into that. Now the second method is used when goodwill is to be raised and then written off. Again here the journal entry will depend on whether the fluctuating capital method is being followed or the fixed capital method is being followed. We'll start with the fluctuating capital method. Journal entry for fluctuating capital method. This is method 2. Again, in the absence of information, the fluctuating capital method is to be assumed. Now we said this method 2 was raising goodwill and writing it off. So to raise goodwill, we will write the following journal entry. Goodwill account debit to old partner's capital account. We will debit goodwill account with the value of goodwill of the firm and credit the existing partner's capital accounts with the goodwill of the firm divided in old profit sharing ratio. So to raise goodwill in the books, we need to debit goodwill account with the value of goodwill of the firm and credit the partner's capital account with the amount of goodwill of the firm divided in old profit sharing ratio. And to write off the same in the second journal entry, we need to debit the partner's capital account in new profit sharing ratio to goodwill account, again the value of goodwill of the firm. So credit goodwill account with the value of goodwill of the firm and debit all the partners' capital account with this amount divided in new profit sharing ratio. So the first journal entry would be to raise goodwill and the second journal entry would be to write off the same amount of goodwill of the firm. Now what about the journal entries when the fixed capital method is being followed? Except for the fact that in the fluctuating capital method we pass the journal entries through the partner's capital account, and here we need to pass the entries through the partner's current account. There is no other difference. So for the journal entries under the fixed capital method, we will raise goodwill for the value of the goodwill of the firm by debiting it and divide it among the partner's current account in their old profit sharing ratio. And to write off the same goodwill, we'll debit the partner's current account in NPSR and credit goodwill with the value of goodwill of the firm. So method 1 needs to be followed when we are going to adjust goodwill through partners' capital or current accounts, and method 2 is to be followed when we want to raise goodwill in the books and write it off. Remember that the net effect of both these methods is the same, and that if nothing is mentioned, we need to use method 1. So in this video we learnt the journal entries for treatment of goodwill during change in profit sharing ratio among the existing partners, the two methods which are available. In the upcoming video, we will be doing sums. For every sum, you will solve using method 1 and follow it by using method 2. And we will also see that the net effect of both these methods is the same.